Hi all, Joshua Steger here from ETFadviser.com.au, and today I'm going to talk about a topic that's really important to all Australian investors, and that's dividends and finding those high dividend yielding investments. So I mean, just in terms of, you just do a search anywhere today and you'll just see so many different opinions and blogs and podcasts and videos talking about dividends and dividend yield. Today I'm going to delve a little bit deeper into the different options for you to access dividends, and I'm going to do like a battle royale. So we're going to look at some of the recommendations here that we've seen that I've collected from podcasts, YouTube and blogs, and then I'm going to look at obviously ETFs because I'm ETF advisor, but I'm going to look at some ETFs and see whether those can stack up in terms of providing a dividend yield, and perhaps they can do that with far less stress. So we're going to analyze some stocks, we're going to analyze some ETFs, and we're going to see how it all stacks up in terms of dividend options for Aussie investors. So as I said, I've already delved through some of these podcasts, YouTube and blogs, and I've got a list of 5 individual stocks that seem to come up quite regularly in terms of people recommending high dividend yielding stocks. So I've got that list, and now we'll have a quick look at the ETF options. So the starting point will be looking at what the benchmark is. So STW is an ETF, probably been one of the longest listed ETFs in Australia, and that's just an ETF over the ASX 200 index. So that's the Aussie index, and this is the benchmark that all investors want to at least achieve for their portfolio, but hopefully beat. So that's going to be our baseline in terms of judging whether these dividend yield stocks or ETFs are going to work for us. And just in terms of the available ETFs, I mean, there's quite a few different options these days. So we go down, so this is from the ASX regular monthly ETF update. So look at the Australian sectors section, and you can see, let's just scroll through. So you can see quite a few different options. So there's IHD, which is iShares Dividend Opportunities. We also have RDV, Russell High Dividend Australian Shares. We've got SYI, Spider, Australian Select High Dividend Yield. VHY, Australian Shares High Yield. And there's also some global options. I'm actually not sure why that's in the Australian list, but I'm basically just going to choose 3 that I think are pretty good representation of ETFs providing dividend yield. So I choose VHY, I choose SYI from Spider, and I'll also choose the Russell High Dividend Yield Shares. So we'll put that all in the mix and see how it all stacks up. So I'll take you to another system. So here we'll start. So basically we want to look at, it's going to be different factors when we're talking about dividend yield, because you've got the total return of the share. So if we have a look here, I've loaded in STW. So this is our benchmark. This is our baseline for the judgment, for the battle royale that we're going to undertake here between individual stocks, ETFs, and the index. And you can see this is over 20 years. So yeah, it is actually 20 years. So we do have 20 years worth of data, and you can see I've currently highlighted total return. So this is a factor. Total return is basically the return that you've got if you invested in STW, and return will be made up of capital growth and dividends. So I can actually break that out and just get, so there you've got a total return of 155%. So you can see over here. I'm going to break that down and just see what the pure price return was over that period. It was only 80%. So that tells me the difference between 155 over here again and 81, which was just the pure price return. The difference between those two factors is going to be dividend yield. So you can see over the 20-year period, and it has been, quite volatile over that period, and it depends where the share market is, whether it's in correction or how buoyant the underlying stocks are in terms of paying dividends as well. But basically this tells me that over the period, well, at the moment actually, it's giving about a 3.56% return. But if we added all these dividends over time, and obviously it's bounced from, so this was the GFC, so that's why you've got a really big spike in terms of dividend yield. But it's basically spiked from kind of like that 12% mark, and probably at its lowest it's been, under 3. But if we tally all that up and add that to the price return here, we will get our total return for the ASX 200 over that period. So capital growth plus dividends equals total return. So now now let's start loading in some of these other our comparison factors here. So we'll add in the ETFs. So here we've got VHY, Vanguard Australian Shares High Yield ETF. Here we've got RDV, which is a Russell High Dividend. And the other one that I chose was SYI, and this is the Spider Australian Select High Dividend Yield. So we've loaded all those in, and we'll just let it reboot. So you can see this is really interesting. So we don't quite have 20 years worth of data, so I might just pull it back to 10 years, just in terms of, these ETFs, these dividend yield ETFs didn't exist. And it just shows you how much the ETF market has grown over the last, 10, 15 years, and why it's become such an important part of our market and lets us access, that 98% of opportunities that exist outside the Australian market. But these in particular are Aussie investments and targeted at dividend yield. So once again, let's look at the total return. So there's our benchmark, STW, and now over the 10-year period, because we've only got data for 10 years for most of these, we're at about 97.34%. Over that period, VHY, so VHY being Vanguard Australian Shares High Yield, has actually provided a higher total return than the benchmark. So it's beaten the benchmark, which is pretty amazing. Then you've got SYI, which has underperformed the benchmark, and you've also got RDV, which has underperformed the benchmark. So sometimes that can happen when you're targeting dividend yield. You just focused on getting, I want a cash flow, I want that dividend yield. Sometimes that comes at the cost of capital growth. So that's a really important thing to remember, and that's something that we'll see with some of these individual stocks that I've identified from my Google searches and whatnot. And it'll show you that, you might be getting a dividend yield, but your overall return is compromised because, the company's not actually growing. But this is definitely a big tick for VHY over that period, actually beating the index and providing a dividend yield over that time. So let's just have a look at what the dividend yield was for these different ETF options and the benchmark. So you can see over the period, currently the STW, so that's our benchmark, so about 3.56%. So that's kind of the blue line. And as you can see, pretty much all three of these ETF, high yield targeting ETFs, dividend targeting ETFs, do have a higher yield than the ASX 200 benchmark, which is obviously what you want to see. So there you got SYI currently at 4.11, RDV 4.24, and VHY at 7.64 at the moment. So pretty amazing. But if we just draw it back, say over the 10-year period, let's look at that purple line. Kind of stands out a little bit in terms of, or certainly in recent times as well, in terms of being a little bit higher than the rest. SYI, I'm not too sure what happened here and how they got a 16% yield. I mean, in 2021, that's interesting. But anyway, it all come out in the mix in terms of, obviously what we saw in the total return. But then also, so that's the yellow line, and you can see a little bit under, over, big spike there, and now it's a little bit under, say, where VHY is. And then we'll have a look at the orange one, which is the Russell High Dividend Yield, and you kind of see that's kind of been pretty much in the middle of the pack. And so that's in terms of dividend yield. So just going back to the total return again, and you can kind of see, the difference. Once again, Russell underperform, SYI, there's our benchmark. So now what we want to do is, just in that quick judgment, we're looking, VHY looks, pretty handy in terms of being a good ETF option, certainly beating the benchmark, which is what you want to achieve, and giving a high yield. So that's 2 ticks. Actually, one other thing we'll look at is price return as well. So this just factors in, once again, what I said before, is that if you're targeting a dividend, there's a cost to that, and that cost will be capital growth. So you have to keep in mind, even though, there's different factors. So remember, total returns are made up of price return plus dividend yield. So just looking at that price return, just to give you a bit more data, STW is the benchmark. And this is just pure price return, not including any dividend yield. And that's actually done the best. And so when you're targeting dividend yield, your price return is going to be lower. So if you're holding VHY over the period, so I'll actually just pull that up on a chart and just show you VHY. You can see the share price. So this is on the monthly chart here. Won't actually, so the monthly chart, I'll actually make that a little bit bigger. So you can see here, because this is a high dividend yielding ETF, the price, so you bought that at say $50 back in 2012, it's only 74 at the moment in terms of price appreciation. So it's done nowhere near, so it's still 71%. So that's VHY, the return over that period, say from 2012 to now, or the highs, recent highs was about 71%. So let's compare that to our benchmark STW, and you'll see over that period, so we'll do it from about 2012 once again. Just get my drawing tool. So 2012 to recent highs is about 100%. So it shows you that's the trade-off that you'll always make when you're targeting dividend yield, because part of your return is paid out every year as dividends, and you live off those dividends. Whereas if you've just got a traditional benchmark, you'll get a little dividend, but the bulk, of your return will still be in the form of capital growth. So let's go back and have a look at some of the options that we had that I found online in terms of what people have recommended as individual stocks, so podcasters, bloggers, videos. Some of these stocks that people have been talking about as being key dividend yield stocks that you should be buying. So the first one's Helia Group. So I'll just actually pull that up for you to show you exactly what it is. So Helia Group is essentially it does lender's mortgage insurance. So when you buy a property and you don't have a 20% deposit, this company does that insurance which is, you pay a fee, but that's insurance for the bank. So you can see it's currently saying it's got a dividend yield of 16.38%. So the dividend yield per share is 0.31. So this is something you should always look at, 0.31. And then we look at to see what the earnings of the company are. And you can see it's not really growing in terms of sales and earnings, but the earnings still exceed the dividend yield. So that means the payout ratio is, let's have a look if it's actually got it here. The payout ratio is only about 38%. So 38% of their total profit they're paying out as a dividend. So that's a pretty safe place to be. You certainly don't want that well over 100, because it means that company's probably using debt to pay dividends, and it's definitely not a strategy that'll work well for that company over the long term. So let's go back to our comparison chart. And so we just have to go back to our comparison chart. I've loaded Helia in here, and you can see, let's just take dividend yield off. You can see in total return over 5 years. I think maybe if we can get 10-year figures as well. So over 10 years, Helia's actually done really well, up 400% in terms of total return, beating obviously our benchmark here, STW, beating VHY and the other two dividend yield ETFs. Just in terms of price return, you can see now that Helia in price return is actually still beating the benchmark, but when you compare the total return, 479% to the actual price return, you can see that a lot of their returns have been paid out as dividends. So we'll just have a look at that chart, and you can see it here now. This is over 10 years, and there you've got, it's currently yielding 16%. Can't be 100% sure. I mean, it seems really high, and just have to be a little bit careful when you've got dividend yields that high that it might actually not be the case going forward. And as we saw with their revenue and earnings, it was actually trending down. So you have to be a little bit careful because this is an historical figure. But you can see it's been a pretty good dividend payer over time. And this is probably COVID where it cut its dividend. But you can see generally that's been tracking higher than certainly our benchmark, and then also our dividend yield targeting ETFs. So it's probably not a bad one a bad stock in terms of just targeting that dividend yield. But once again, you've got to be careful. You've got to keep on top of it. And as I said, the issue with Helia that I see is just the growth. It doesn't have any sales growth, and the earnings per share growth is actually diminishing. So that, if they're paying out 38 cents a share in dividend, and in 2027 they're only going to earn 0.44 or 44 cents a share, that dividend might be under pressure. So that's something to keep in mind. When you're looking at dividend yield in individual stocks, you've always got to be looking forward. Whereas if you compare, because you can't be sure, as I say, past performance is not a reliable indicator of future performance, and the same thing applies to dividend yield. So keep that in mind, and that's why it's another reason, why you should consider ETFs, because they will be actively managing that portfolio, so you don't have to worry about whether Helia is a good business or not going forward. If it's a good business and it's a good yielder, it'll make up part of these ETFs. And if it's starting to fall apart and no longer a good dividend yielder, and there's risk there, it will no longer feature, or certainly be reduced, far reduced as a holding in these ETFs. So these are kind of giving you that active management that you'll have to undertake yourself if you're going to pick the shares directly. So that was the first option. We'll look at the next recommendation. So Soul Patts has been a long time listed stock in Australia, and it was always revered for its ongoing growth in revenue and earnings, but also its dividend yield as well. So you can see, once again, 10-year period, you can see it's actually done really well in terms of beating the market. So it's done 250%. So 2.5 times the ASX 200 over that period. Certainly couldn't even beat VHY in this instance either. So we'll just have a look in terms of their dividend yield as well. So total return was 250%, but their price return, so we'll just take that one off, price return is about 160%. So you can see the difference between total return and price return is the dividend yield, compounded over time. Well, it added into the mix every year. So here we have, let me just clear this up a bit more. So here we've got Soul Patts dividend at 2 points. So it's actually quite a lot lower than, it's 1%, over 1% lower than the benchmark, and certainly lower than these ETFs. So you can see it's tracked down there over the last 10 years. So it still pays a dividend. It's not particularly high, but from a total return basis, it's done really well. And that's probably one thing you want to keep in mind with targeting dividend yields. You still want your company to be growing. That's the ultimate goal when targeting dividend yields, is you want your company to be growing and you want the dividends to be growing. And that's not always easy. So yeah, just looking back again, dividend yield is quite low compared to the others, but it has been a growing company. But once again, past performance, not reliable indicator of future performance. If you're going to pick Sol, you're going to have to keep a close eye on their business model and whether they're able to maintain their growth and maintain their dividends going forward. The next one we'll want to look at is Woolworths. So that seems to be, obviously a blue chip stock in Australia and one that many people hold. So you can see over a 10-year period, Woolworths has actually underperformed the ASX 200 over in a total return basis. So it's getting a bit, it's kind of like almost 12% there underperformance over 10 years, which is pretty amazing. So let's look at the dividend yield over that period as well. So you can see Woolworths at 3.28 actually has probably had a lower dividend yield than the green line, which is the index over that period. So that's really interesting as well, and certainly didn't beat the ETFs in this instance. So that's an interesting one. Woolworths will also touch on a bank. So here we've got Westpac. So this will be quite interesting because banks are revered for having really high dividends, and that's a reason why Aussie investors absolutely love them. So here we've got the total return over 10 years, and there's the blue line, which is Westpac, and you can see Westpac's actually well underperformed the index over the last 10 years, which is interesting. And let's delve into the dividend yield as well. So Westpac dividend yield is actually quite significant there. It's over 1% higher than the benchmark. It beats these two. Well, this is actually the current dividend yield, so it beats these two ETFs, but can't beat VHY. But let's just have a look at the trend, which is the blue line over time, and you can kind of see, it's kind of been middle of the range, but over that time it has generally beaten the benchmark. So that's quite interesting as well. So, that's probably what we expect from banks. So interesting data to keep in mind. And that's probably I'll probably touch on one of the other key supermarket stocks, which kind of everyone wants to talk about as well. Seems to come up in the blogs quite a lot. Here we are, Coles Group. And Coles has actually done, this is once again over 10 years, Coles has actually beaten the index, unlike Woolworths, over this period. So you can see the blue line, a bit of underperformance here, but at the moment it's actually popping up and showing outperformance in a total return basis versus the benchmark. Then we'll have a look at the dividend yield. You can see it's actually lower and generally been lower even than STW, the benchmark. So that's interesting as well. So just in terms of a summary here now, we've got, just in terms of summarising, obviously, we've got a big tick here for VHY. That's really, just in terms of all the data that we've gone through in terms of total return, dividend yield, it's really kind of stood out in terms of being a really good ETF option to get that dividend yield without too much hassle. Then, we've looked at a few different stocks from Sol to Helia to Woolworths, Westpac and Coles. And you can see it's kind of a mixed bag. Some of them provide, not many, or some of them have provided a higher total return than, say, the benchmark and VHY, but not many will be able to achieve the same kind of annual dividend yield as VHY or even some of these other ETFs, RDV and SYI. So just in terms of the mix, if you're going to pick individual stocks for their dividend, you're going to have to actively manage those positions. You've got to know where your stock is in terms of revenue and earnings and whether that dividend is sustainable. Whereas if we look at something like VHY or RDV or SYI, we can just buy an ETF and it's kind of managed for us, and we don't have to worry about, the dividends being sustainable or, what the individual companies are doing. they're going to manage that portfolio for you, and they're going to target that dividend yield, and that's going to probably be a lot less hassle for most investors who want to target dividends. So that's basically the summary. Battle Royale, I'm going to lean towards ETFs just because I think something like VHY ticks a lot of boxes. It gives you that yield, and it gives you that kind of element of active management, and also gives it long-term return, has done well over a long period of time. And if you're going to pick individual stocks, you've got to actively manage them. You've got to keep on top of it. So that's kind of the rundown. I'm going to give ETFs the win just because I like to keep it really simple and really pure and just get that dividend yield in the easiest way possible.